have to be aligned with my premise. And the premise is the final phase is the greatest capital appreciation, and it accelerates. It happens in a short amount of time. And let's just use that, excuse me, let's use that as perhaps a year and a half from now. And that's a wag. It's a wild guess, but it's not 10 years from now. I don't believe that. Others do, and you can. And I'm not saying I'm right, but the market will tell. So going back to your question, that peak at 2011 was a 33 to 1 ratio, and we're around 50 right now. So if I'm right, we're in the final phase, it's got to do better than that. So that means it's got to go, maybe half again is what it is now. Let's say if it goes half again, it'd be 25 to 1, which is better than a 30. So in that case, you would be doubling your money relative to your gold position if it was all silver. So yes, I do believe that's a signpost. I do believe it's a marker, and I do believe that we're going to do better than the 30-to-1 ratio we experienced in 2011. Yeah, let's be a bit of a long-winded answer. I'll try to make it succinct. I mean, anyone that's listened to me over the last, few years or the decades I've been on the web, I've talked about 90% of the move comes the last 10% of the time. Those are not exact numbers, but the idea is correct. Forget the final phase of any market, especially the metals, is the acceleration phase, where you get the biggest capital appreciation in the shortest amount of time. To prove that point. And does it work every time? Yes and no. I mean, it works to the idea that you get an acceleration. So in 1979, January, silver was $6. A year later, January 1980, it was $50 intraday. And so it made 850% gain in a matter of like 11 months. So it was like the exact math on that, I forget, was like 87% of the move and 7.5% of the time. So the idea is we're there. We're in that part. Now, the answer, the further the answer is, well, how high is high? And as I like to say about how to really trade stocks or futures is, buy a new high. Because if a stock goes from 5 to 50, how many new highs does it make? A lot of them. We don't know. It depends on the stock. You can see once it peaks, you can count them. But, a new high, new high, new high, new high. Oh, my goodness. And once you get into this mode, I mean, it's absolutely stupid to trade to the short side. You must trade from the long side the whole way up until it peaks. And that's why, now if you're hedging, that's different. Hedging is not speculating. If you've got it locked in, you think, I'm happy at, $110 silver, and that's where I want to hedge half my portfolio because I don't want it coming back to 50. Well, that's a different modality than saying, oh, I'm short in silver, it can't go over 100. So anyway, two things. We're in an acceleration phase, and we are need to trade from the long side only. Last thing is I did this run to gold analogy, Danny, you've probably heard it. I'll try to, again, be brief, but I said,
Silver's most dramatic example came between 1979 and 1980. In less than a year, prices surged from single digits to nearly $50, delivering extraordinary gains in a remarkably short time. The key takeaway isn't the exact percentage increase, it's the structure of the move. Nearly all the upside occurred late in the cycle. This pattern appears repeatedly across commodities, equities, and currencies. Once momentum takes over, price discovery accelerates, and traditional valuation metrics lose relevance. Markets stop asking what something should be worth and start asking how fast they can get exposure before it's gone.
The run to gold has begun, and I said that back when gold was around the 2000 level, when the banks started buying gold hand over fist. I said, look, bankers are in. They're buying at a greater rate than they ever have in the past, and the run has started. But the run starts with the, kind of dragging your feet walk, and then a normal walk, a brisk walk, a light jog, a full jog, a fast jog, a light run, a full run, and an all-out sprint. And so one of my members asked me like 2 days ago, and she said, are we at the all-out sprint? Because in a way, if you look back a year ago, I mean, look at the acceleration we've seen, and you could make the analogy. I don't think we're at the all-out sprint, but we're past the light jog, past the jog, into maybe the fast jog, the way I see it. We've yet to go into the light run, the full run, and then the sprint. And those are when the public comes back into the market. So right now we've seen many, many silver investors that have bought silver for years dump. They are just selling their silver and they can't, they're happy to take, $10 under spot for it or whatever the market's bearing right now. So until that clears and there's an emphasis for new buyers to come in thinking or feeling that, silver's still a bargain when the gold silver ratio is 50 to 1, when it could be 30 to 1 or 15 to 1. And I think that will happen. And it's really a bifurcated market from east to west, not only in the arbitrage, but in the attitude toward purchase. The West, North America, is primarily sellers, whereas the East, Asia, primarily is still buyers from the retail side.
In strong bull markets, new highs are not warning signs. They're confirmation signals. Assets making repeated highs are doing exactly what they're supposed to do. Fighting that trend by betting against it is historically one of the most expensive mistakes traders make. The correct posture during an acceleration phase is alignment, not resistance. There's a critical distinction between hedging and speculation. Protecting profits is rational, but betting on an imminent collapse while momentum is building is not. Until a market clearly peaks, the dominant force remains upward pressure driven by capital inflows and fear of missing out.
I have to be aligned with my premise. And the premise is the final phase is the greatest capital appreciation, and it accelerates. It happens in a short amount of time. And let's just use that, excuse me, let's use that as perhaps a year and a half from now. And that's a wag. It's a wild guess, but it's not 10 years from now. I don't believe that. Others do, and you can. And I'm not saying I'm right. The market will tell. So going back to your question, that peak at 2011 was a 33 to 1 ratio. And we're around 50 right now. So if I'm right, and we're in the final phase, it's got to do better than that. So that means it's got to go, maybe half again is what it is now. Let's say if it goes half again, it'd be 25 to 1. Which is better than a 30. So in that case, you would be doubling your money relative to your gold position if it was all silver. So yes, I do believe that's a signpost. I do believe it's a marker. And I do believe that we're going to do better than the 30-to-1 ratio we experienced in 2011.
Since central banks began aggressively accumulating gold, a structural shift has been underway. What started as quiet institutional buying has evolved into a broader confidence signal about fiat systems, sovereign debt, and financial stability. This run follows stages, from slow accumulation to eventual public participation. Today, gold appears further along that path than silver. In Western markets, many longtime silver holders are still selling, while Asian demand remains firm. That divergence suggests silver has not yet reached its speculative phase. Historically, silver tends to move last and fastest once public participation finally returns.
I wrote an article, one of the first I put on the web, quarter of a century ago, called Engineering the Price of Gold. And I explained how you determine the paper price of gold. And going through that arithmetic, I said, okay, well, what about silver? Silver is really not a monetary metal, but how do we determine? And so I started using the gold-silver ratio as a means to determine. And what I call the classic or monetary ratio is 16 to 1, 15 to 1. And on that basis, I said, and at the time, the theoretical price of gold was 2,500, and we were at like 250 or something. So it had like a 10 bagger to go in theory. And so then if you take, and I said it could go to 10 to 1 in an overshoot. So 10 to 1 would be $250 gold silver, $250 silver back then. So I don't rule it out. And on an overshoot, we might go past the classic or monetary ratio of 16 to 1. And if that were true, then it's got to be less. It'd be 15, 14, 13, 12, say 10. 10's easy to do in your head. So if you got $5,000 gold and you do a gold silver ratio of 10, you're looking at $500 silver. Now, do I really, really think it's going to get there? And the answer is I do not. But I certainly think it's getting above 30. So where does it land? 25, 20, 15? Does it go to 10? I don't know. Could. I certainly wouldn't rule it out. If it did that, I believe it'd be a spike like it shows on the chart here. And you'd want to be sitting at your computer when it hit that. Swap out for gold or sell out or whatever, but it's possible. Certainly.
The gold to silver ratio offers critical insight into relative value. Past peaks saw ratios compress dramatically, reaching levels far below today's readings. If silver is entering its final phase, history suggests it must outperform gold to close that gap. Whether the ratio settles at 25, 20, or even lower is uncertain, but overshoots are common during speculative extremes. These moments tend to be brief, violent, and emotionally charged. They reward preparation, not prediction. Investors who recognize these signposts can make strategic swaps or exits rather than reacting in real time to volatility-driven headlines.
Looking at the equity side, we're still undervalued across the board. I mean, some of the bluest of the blue chips are still undervalued relative to the price of gold and silver right now. So they're pretty good buys. And I think everyone that follows your work now knows that, Rick Rule sold, a good portion of his silver and is buying, silver miners. And a PE is not a very good measure of gold company. It's free cash flow. But at the top of the market, it's actually a pretty good marker. And at the top of the market, a good silver company will sell for about 50 times earnings, where a good gold company will sell for about 30 times earnings. So right now, we are undervalued across the board. I mean, there might be some juniors that are overpriced or something, but as far as the blue chips and the mid tiers and even the junior producers, all the ones that I follow are undervalued right now. So if you're late to the party, you might consider doing stocks. I always advocate the real metal first. But if you're going to add to your position, you could do a Rick Rule. You could sell your metal for stocks or part of your metal for stocks, which is what he did. You could, there's lots of ways to do it. But, and that doesn't mean that if you buy today, you're guaranteed the stock price is going to go up. We could get a correction any day. In a bull market, we usually get some pretty scary corrections on the way up. Enough to where, some of the Twitter guys will come back on you and me and get in our feed and say, see, Danny, you and David are wrong. Silver's back down to $80. It's under 100. Hasn't touched 100 in 6 weeks. See, you guys are wrong. And then, 3 days later, it goes limit up. It's 120. I don't think this bull market's over, as I keep stating. We haven't got the panic manic phase. And the fundamentals are so strong that, the reason gold is there is because it's the money it's the ultimate money. It's the money of last resort, and the banks are still buying hand over fist because if this whole system collapses, which it won't, but if it's trending that way, and it is, because the treasury market is a mess, no one really wants to buy long-dated assets based on their credit. The credit of the United States, the credit score of the U.S. is going downhill rapidly, not so much by Moody's and other rating agencies, but by the marketplace itself that says, I don't want to buy your treasury bills, bonds, or notes. I don't want it. And so the Fed has to buy it and make up for it, which is going to push interest rates up, Mr. Trump, regardless of how much you want the Federal Reserve to lower the discount window or federal funds rate. It's not going to work.
The broader backdrop is a global shift away from credit-dependent growth toward tangible necessity. As sovereign debt burdens rise and long-dated bonds lose appeal, capital gravitates toward what the world physically needs: energy, food, and raw materials. Commodities are not optional, they are foundational. This is why gold remains the ultimate monetary asset and why silver, industrial metals, and mining equities remain historically undervalued relative to financial assets. Volatility is inevitable, but the long-term divergence is clear. As credit weakens, real assets gain strength, and that transition reshapes markets faster than most expect.
We're in a bifurcation where we're going from things on credit to needs. The commodity sector are needs. You need cotton, you need oil, you need soybean oil, you need soybeans, corn, wheat, cotton, you need all of that. You need the metals. And because of that fact, everything that's on credit, which is, your car loans, your mortgages, your commercial real estate, all those things are in jeopardy. But everything that's a tangible, real wealth is gaining in value because it's the most valuable. You've got to have oil or you don't have any energy. So those things, the commodity sector is going to be king of the hill eventually. In other words, the stock markets worldwide are generally going to trend down, and the commodity sector generally is going to trend up. And they're going to crisscross. If you plot the S&P versus one of the Commodity Research Bureau's indices. And you're going to see those indices cross where the commodities are going up and to the right, and the stock markets are going down and to the left.